Hi, my name is Aristotle. I'm with RealWealth. I'm one of the investment counselors with RealWealth. And again, thanks for joining us on our Thursday webinar. For those who are usual listeners, we do this every Thursday, an educational webinar or a market webinar. And today we are going to be talking about taxes. And if you're joining us today, you're probably not necessarily excited about talking about taxes, but you're definitely excited about saving money on taxes and how to do that. And today we're going to be talking about tax savings for you and also just how to maximize your deductions as a real estate investor. When I first got started in real estate about 8 years ago, I knew nothing about like deductions for taxes or anything, but I did have a couple of small businesses. And so I was a little familiar with what I could deduct, but I didn't realize that you could deduct things like property management fee and your cell phone and all these different things. I'm like, wow, that's pretty neat. So this is a business. Real estate investing is a business. So if you're new to investing and you do need some tax breaks, this is a great place to start. Real estate investing also offers other benefits, but there are many people that get into real estate just for the tax benefits. So today we're going to be talking with a company, a new resource, a new company that we're working with called Keystone CPA. You might have heard of them before. They've been on the circuit and the investor circuit for a long time. And so, in fact, Amanda down below here, Amanda was on Kathy's podcast, I think back in April of this year. So you might have heard her as well. And I'm going to give you a quick introduction. Amanda and Matt, how are you guys doing today?
Great. We're so excited to be here.
Good. Thanks for having us.
Yeah, thanks. I really appreciate you guys coming on. I know end of the year is kind of an interesting year, but we're rolling into tax season not too long from now. So it's great timing to have you guys on. So again, we're going to go ahead and get started. So if you can go advance to the next slide there for me. I'll read our disclaimer before we start. So it says here that the strategies mentioned in the presentation may not be appropriate for everyone, and other options not mentioned may be more suitable for your specific circumstances. And consult your personal accountant, which we have one today, tax advisor, and or attorneys to discuss your specific situation. Past performance is no guarantee of future results. Real estate purchases are subject to investment risks, including the possible loss of amounts invested. While every effort is made to maintain accurate and current information, the possibility of errors and or updates always exists. So as always, it just means, to sum it up, do your due diligence, seek out professional attorneys, tax accountants when it comes to all the legal issues. So before, I'll go ahead and advance to the next slide, but I also wanted to note as we start here, we're going to be taking doing the Q&A session at the very end of this webinar. So as you see on your GoToWebinar panel, you'll see a chat box or a box where you can type in your question. So as we're going along here, we're not going to answer questions necessarily as we're going along, but at the end of the presentation, we will definitely take any questions you guys have. So we're going to try to answer as many as we can. So Amanda and Matt, thank you again for joining me today. This is your first webinar with us, and so I appreciate you guys coming on. Why don't you go ahead and give us a little bit of background about yourself, and we'll start from there.
Yeah, thank you so much, Aristotle, for having us. And we're so excited to be here for our first time on the RealWealth Network podcast. Like Aristotle said, I've been friends with Kathy for a long time. I was on one of the podcasts with her recently. It's always a great time. So really excited to be here and share some tax strategies with all of you.
Yeah, hi, my name is Matt McFarland. This is Amanda Hahn. So we are the owners of Keystone CPA. We are husband and wife. We've got a great team behind us that helps us with tax planning. I'd say probably 90–95% of our clients are real estate investors, whether that's, kind of runs the gamut from full-time investors down to people who, have the W-2 job, working on the side, investing on the side and that kind of thing. So, yeah, it's just kind of our passion is to help real estate investors. What we understand, what we know, what we're good at.
Yeah, and besides being tax strategists for real estate investors, we are real estate investors ourselves. So we, love to use real estate for our own tax saving strategies too. So yeah, really excited to be here. And some of you might have seen us around on Bigger Pockets or Talks with Google, or maybe you read our book. If you haven't, you can definitely check it out. There's a little image of that on the bottom. It's called Tax Strategies for the Savvy Real Estate Investor. So let's go ahead and get started. We like to talk about from an investor's perspective, one of the most common mistakes that people make is not understanding that as a real estate investor, we are also business owners in the eyes of the IRS. And so what happens is, you always hear people talk about, the tax law is written to benefit business owners. Business owners get to take a bunch of tax deductions and write-offs. But what's interesting about that is, as an investor, we are also a business owner. And when I say business owner, I don't mean like I have an LLC or I have a corporation. I simply mean you are in the business of investing in rental properties.
Yeah, so I think a lot of times the question comes up is people aren't, they're not sure what they can deduct. They don't, they don't know what the rules are. They overlook a lot of common expenses that I think all of us as investors and business owners, we encounter on a day-to-day and week-to-week basis, right? So, business education, meals, travel, home office car, those are just to name a few of some of those more common expenses that we see overlooked because people just aren't sure, again, what they can deduct or how they do it, or, is it okay to deduct it, that kind of thing, right?
Yeah, for education expenses, common examples would be like if you're going to a real estate conference, right? Now that we're out of COVID, a lot of people are traveling, going to conferences. So when you're going to those conferences, make sure you are taking your tax deductions for those, whether it's the traveling there, the hotel there, like Matt said, the business meal and things like that, because those do add up, and especially if you're someone in a higher tax bracket, right? If between federal and state, you're in the 30 to 40% tax bracket, $1,000 in tax write-offs can get you $400 in actual taxes saved. So very important to make sure you understand that. As long as something is ordinary and necessary for you as a real estate investor, then there are often times where these could become tax deductions. And as real estate investors, we all a lot of times use our cars for business expenses, right?
Yeah, I mean that's coupling that with a home office, right? If you have a dedicated space, room in your house that you can use solely for your business. The beauty of that is not only does it give you the ability to write off a portion of your home expenses that might not be otherwise deductible, like insurance, utilities, repairs, things like that. We deduct mortgages and property taxes. It's all that other stuff that now we can take a percentage of as a home office deduction. But on top of that, now anytime you leave the house and drive somewhere for business purposes, all of that is now business expenses instead of commuting miles. And so that's where the car expense can come in really handy is you can deduct your mileage, or if it ends up being more than that, you can take your actual auto expenses, which would include depreciation on your car too. So it's not uncommon for us to have clients that are, they've got a expensive car, right? They're using 80, 90, 100% of the time for business. And, the first year they might go to write off almost the entire purchase price of the vehicle because of through depreciation expense. So it can be a huge deduction that you might be overlooking for sure.
Yeah. And what's interesting about that is, for car expenses, the depreciation is based on the purchase price. So like even if you bought a car this year and it's financed, right? So I'm only putting a little money down or it's fully financed, it's possible to take a deduction for the entire purchase price with no money out of pocket, right? So these things are, and as a business owner, we don't care whether you have an LLC or a corporation or things like that, as long as you are in the business of investing in real estate, then odds are you're able to take a lot of these legitimate tax deductions. And there's a lot of times you'll hear like attorneys or maybe even some tax advisors say, hey, you have to have an LLC before the end of the year. You have to have an LLC.
You have to run to the back of the room and have an LLC, right?
Yeah, you have to have an LLC to then pay from the LLC to take a deduction, and that's not accurate at all. In fact, just because you have an LLC does not mean everything you pay through the business is a business expense, right? So if I had an LLC and I just went on vacation, or I paid for my kids, the elementary school expenses with it, that doesn't make it an expense, right? So the IRS looks at it the same way. Is this expense ordinary and necessary for your business? If so, then you can take a tax deduction against it. But one of our favorite part about maximizing expenses, since we were talking about kids, is the concept of income shifting. So income shifting simply means the ability to have your kids help you out in your real estate business and taking a tax deduction for the money that you're paying them.
Right. So every time I see this picture, I can't get over it. Right. This is where originally we thought this is dad. This is cute. Dad showing kid how to use the computer, or Excel, or something. But really, since COVID, we all know this is a kid teaching dad how to use Zoom or GoToWebinar or one of those platforms. Right. I mean, that's really what's going on here. So yeah, I mean, income shifting is it's a great way. I think the question we get a lot is, it's how do I deduct my kids, right? But really, the question is, you really got to look at how do you get them incorporated into your business so they can help you in your business and take a tax deduction for it. Because we all know people who have kids, the kids are expensive. We're giving them money anyway, right? We're trying to find a tax deduction for it.
Yeah. So I think, for example, if you have a rental property and there's tenant turnover and you're having your kids help out, maybe by painting the place or, helping you with things on the property or even helping you with, like Matt said, technology and things like that needed for you as a real estate investor, then the money you pay them becomes a legitimate business expense, right? There's nothing that says you cannot pay your kids. You can pay other, whoever you need to for the work that's being done. And so if you are, in the, let's say 50% tax bracket between federal and state, and you paid your kids, $6,000, that could mean a $3,000 tax savings for you. And of course, the other wonderful benefit is now your kids have learned what you're doing in real estate, right? Teaching them those great habits. And, they can also take that money and put that into like a retirement account, for example, a Roth IRA, and that could grow tax-free for the rest of their lives. So really, really powerful way to, to teach your kids about financial independence, about, business planning, and also take a tax deduction in the interim as well.
And just say too, we get this question a lot too, is this work doesn't have to be just for kids. This can work well with, a lot of people maybe have, parents who are older, but they're still, wanting to do something and work and, make some money. Maybe you're supporting them financially. What a great way to have them help you in your business. You can give them the money now, we're taking the tax deduction for it. They're feeling good because they're still, kind of staying in the day-to-day, doing something right, and they're helping you grow your business. So it can definitely be a win-win, not just for kids as well.
Yeah. So I know we'll have a lot of questions about income shifting because we always do. Everybody's like, what about this? Or how about my kid? So we'll take all that at the end, but wanted to share a list. So these are crazy deductions allowed by tax courts. The story behind this is here's a list of items where the IRS disallowed deductions for these taxpayers. So someone tried to deduct pet food or wigs from private plane. The IRS said no. And so the taxpayers fought. They fought back and went all the way up to tax courts. And then the courts made the final determination in these scenarios where they said, yes, these are legitimate business expenses. And,
So just to clarify too, these are not all of Aristotle's 4 cases, right? It's not his things.
Right.
Girlfriend. I'm interested to hear how you can deduct a girlfriend.
Yes, you and a lot of people
are, yeah.
Yeah, I was gonna say that's a one we get a lot. So, so all of these, it comes back to what we said on the first slide, right? Ordinary and necessary for your business. I know we have real estate investors with us today. Real estate investors
are very creative.
Yeah, some of the most creative people I know. And believe it or not, a couple of the court cases here are from creative real estate investors in terms of strategy. So the private plane one was investor.
Yeah, I think I was an investor who, felt like he needed a private plane to fly across the country to visit all his properties. And I, took the IRS to court. He was actually, based on all the documentation, he showed that it, wasn't out of the ordinary for him to have a plane to go visit all his properties. So, I guess a life goal for the rest of us, right? But girlfriend also was a real estate investor. It was somebody who had some properties, and he was having his girlfriend help him manage his properties and, paying her or what have you. And so, the funny thing about this one is we were talking somewhere once, and, kind of was the end of our presentation, ran out of time, run out of stage, and somebody like Aristotle yelled out, "Tell me about the girlfriend story," and so I just blurted out without even thinking about it. "Oh, he was paying her for services." Like, oh, that probably didn't sound so good, so. But.
So that's very similar to the concept of income shifting we just talked about, right? Matt said earlier, it doesn't have to be just your kids, it could be other family members or just other people. And so on first glance, the IRS is like, hey, you're giving money to your girlfriend. That's not a tax deduction, right? We cannot take a write-off for it. But he was able to prove that the money that was given to his girlfriend was actually compensation that he paid her to help out in his real estate business. So the reason we're sharing these, these kind of court case results with you is not to say that you can deduct your wig or your pet food or maybe your babysitting fee, okay? But it is to say that all sorts of stuff could potentially be tax deductible, it has to fit your facts and circumstances. Something that we say a lot is, if you have the right facts, you can pay little to no tax, right? And that's what planning is all about. So before you spend money on something significant, talk to your tax advisor, talk to your team, right? Call your CPA or send them an email, say, hey, I'm going on this trip. I'm thinking of buying this thing. It's a pretty big dollar amount. How can I take this as a tax deduction? Because if you just say, hey, I'm going, can that be a tax deduction? I'm giving money to my kids, can it be a tax deduction? Odds are the answer is going to be no. But if you said, how can I take a tax deduction for the money I'm giving my kids? Now, both you and your tax advisor are in a more strategic mind frame, right? So you're both thinking, yeah, how? Well, if I just give it to him, I can't, but if I have him help in my business, then I can. And so the question itself, of having a powerful question, can create really powerful answers when it comes to tax savings.
Yeah, I think that's really worth noting, right? It's changing the facts, right? Changing your facts, your situation to get the facts you need to take advantage of some of these things. That's really what it comes down to, and planning ahead to do so.
So another obvious huge benefit for real estate investors is the concept of depreciation, right? So when we buy a rental property, even though the values are going up, the IRS allows us to take depreciation on the property over time, right? And so it's one of the best benefits of being an investor because we're taking a tax write-off on a paper loss, meaning no true losses happen. I'm just writing it off according to the tax code.
Yeah, I like that car example we talked about, right? This is depreciation. The starting point for depreciation is based on your purchase price, right? So all of us real estate investors, we go out and buy a $500,000 property, we put $100 grand down, we're getting a loan for the other 100,000, right? So your depreciation starts at 500. The starting point for the calculation is 500, not your $100,000 down payment. That's the beauty of using other people's money when we're going out and using leverage and going out and buying rental properties, right? And Amanda, I mean, you hit the nail on the head. It's just this paper expense that the goal is we buy and cash flow positive properties, but with tax strategies, maybe income shifting, maximize their home office, car expenses, using depreciation. The idea is to get that positive number, cash flow number down to zero at the very least, so that we've got cash in our pocket, we're not paying any taxes on it. And then, even so, maybe there's times where we can create a loss. That might be beneficial in our tax situation as well. But that's the beauty of all these strategies. We're looking for ways to reduce your taxes now, save more money now, use that money to go and reinvest, keep the ball rolling and building your wealth, right? Keep generating more cash flow and buying cash flowing assets, right?
Yeah, and I think probably 9 times out of 10 when we look at tax returns for investors, they're taking depreciation in kind of the normal sense. So if it's residential, writing it off over 27 and a half years. There's actually ways to accelerate that with a cost segregation study. And what that is having a cost segregation firm look at your investment property. And instead of saying, well, there's, a $100,000 building here, but to break out the components of that building. So that $100,000 building is in fact made up of $10,000 of flooring, $6,000 of appliances, $30,000 of specialty plumbing. And the benefit of having that breakout on paper is that when you file your tax return, your tax preparer can take faster depreciation. So instead of waiting 27 and a half years to write it all off slowly, maybe we can take a huge chunk of it up front in the first 1 to 5 or 7 years of owning a specific property. And so that's a really, really significant benefit. A lot of times when you hear investors talk about how they were able to save thousands or hundreds of thousands of dollars in taxes using real estate, odds are they are utilizing accelerated depreciation. Because like Matt said, right, it's not about losing money. We're making money, but we are strategically creating the tax losses through things like accelerated depreciation. And right now we have what's called bonus depreciation, which simply means that we're accelerating it even faster. So think of this as turning wheel, so going very slow, and now we cranked it up a little bit. But this year with bonus depreciation, it's just kind of going on turbo, so that you can get as much depreciation as possible into the current year. We're going to go over an example of that shortly, just so you kind of see the power of accelerated depreciation.
Yeah, that's why we love depreciation as investors, as tax advisors. I mean, it's again, it's just you're getting the same through a cost segregation too, right? You're getting the same amount of depreciation. It's just we're trying to front load it. We're trying to take more of it now, right? So we can use those deductions sooner, again, save taxes sooner, and use that savings to again reinvest and continue building your wealth.
Yeah, so I think, saving on taxes is more than just about saving the tax itself, but it's really just more money for you to invest. So if you can save $20,000 in taxes, then that's a down payment on another $100,000 worth of real estate, and that's really how wealthy people are able to grow so quickly. So I wanted to share our next slide. So probably a lot of you have been told this or have heard of it, where people say the more income you make, the more taxes you pay, right? You pay more tax because you made more income. We hear that all the time. But if you look at these individuals, so for the first three is actually from a New York Times article that came out, I think a little bit, maybe end of last year, when they said these individuals, Bloomberg, Elon Musk, Bezos, that they made a lot of money, clearly, but paid very little federal income taxes. And then the last guy is Brandon Turner. Some of you might know him from Bigger Pockets. He's a client of ours. So I told him I would put his image here with, all the cool people.
We need somebody with a beard in these photos.
Yeah, someone we can kind of relate to. And, he always goes around telling people how, we help them to pay no taxes. But we just wanted to share this, so when people tell you the more money you make, the more taxes you pay, that's absolutely incorrect. Because these are clear examples that we all know, right? People who make a lot of money but pay very little taxes. The article, the New York Times article, you guys can look it up, but it kind of made it sound like there was these very advanced strategies that these people use just for the super wealthy. One they said was like these people were able to, borrow from their appreciated assets without any taxes. Well, as real estate investors, we do that all the time. Right? You buy property for $100,000, now it's worth $300,000. We do a cash out refi or a HELOC, and we pull out the money to invest more. We don't have to pay taxes on the money we pulled out. It's just a refinance, right?
What else? Oh, it was also talking about, along the same lines, not about the interest on those refinances. Now, hey, they're using them, they're deducting all that interest. And it's like, well, you get to do the same thing, right? You borrow against an asset, you use that money to go buy another rental property. You can deduct that interest from that extra borrowed money against that new rental property. That's how it works in the tax world.
Yeah.
So you can do it too.
Yeah, they talk about these people have real estate or build companies and they don't have to pay any tax because the asset has appreciated. Again, same thing for real estate investors. Our property appreciates in value. We don't pay taxes on it.
Or when they go and sell an asset, they're not paying any taxes because they're doing this fancy exchange thing. It's like, well, everyone can do a 1031 tax deferred exchange, right? It's an opportunity for all investors.
Yeah, I think when you break it down, it's really amazing that all these strategies that are touted as highly advanced for wealthy people are really things that we as real estate investors use all the time. But I know we can't really relate to a lot of these high income billionaires. So we put together a tax savings in action. So this is a profile of someone that we worked with, I think about a year and a half ago, that they were able to accomplish. So this is a married couple where the husband, I think, was in the medical field and had a good amount of W-2 income, right, about $320,000. They were brand new real estate investors, purchased 2 properties in the first year of being investors. So it had, a good amount of cash flow, right? So this is the profit after subtracting, interest, taxes, and all that stuff. So with proper planning during the year, they had some expenses that they were able to take advantage of, right? We talked about income shifting. So they had young kids, nothing super crazy, $2,000 shifted to their kids. They had car and home office expenses that they claimed. Again, nothing crazy, didn't go out and buy a Tesla or anything, right? Small but steady. On those 2 properties, what they did was they did cost segregation to accelerate the depreciation. So again, 2 single family homes, okay? Cost segregation got them $245,000 of depreciation. Because one of the spouses was a real estate professional, they were able to use all of that to offset their rental income as well as W-2 income. So you can see this is a profile of someone who made over $300,000, but their taxable income actually was under $100,000 with the right planning. So again, these strategies, not just for the super wealthy, for everyday investors too. If you're doing the right things during the year, you can have those same results. But here's the key point. The key point that I kind of briefly touched on is doing the right things during the year. Okay, and the most common mistake that investors make is thinking that tax return filing and tax planning are one and the same.
Yeah, and it's just keep in mind, right? What is tax return filing? It's taking the information that has already happened, right? Happened last year. You're gathering all your documents. You're putting it together on tax forms. Hopefully, putting it in the right tax form. Having, gathering the right information, answering the right questions, and it spits out and tells you kind of a summary of what has happened, right? Whereas the difference there, I think the misconception is that tax planning is, looking at it proactively, right? You want to look at things before they happen. You want to meet with your advisors. You want to ask the right questions before you do transactions, so that you're not coming into a meeting on April 10th saying, "How do I save taxes for last year?" Right? Because that's going to be challenging for a lot of people, obviously.
Yeah, tax planning is doing the right things during the year, so that by next April you are, you have the right facts, right? And having the right facts is super important, because IRS, you guys probably know, right? They got billions of dollars more in additional funding. I don't care what they tell you. I mean, a lot of that's going toward audits. They can say it's going to, answering phones and taxpayer support, but the biggest chunk of that is going towards audit. And it doesn't mean that we should throw away the strategies, right? We still are going to use all the strategies, but it just means that it's more important for you to have your documentations in line, so that if you're audited, you can substantiate your case. You have the right facts.
Yeah, remember, because if you do get audited, right, we're not getting audited a month after we filed our tax return where everyone remembers what they did on their tax return. You're getting audited 2 to 3 years down the road. So even more important to have your documentation in place now, so that you don't even have to worry about this, right? Even if you did get audited, you've got all your ducks in a row, right?
Yeah, so it's more than just saying I wanted to shift income to my kid, right? It's actually doing it. Them actually doing the stuff, you actually paying them, having the documents for that. If you're claiming real estate professional, actually having the hours, being able to prove your hours, accelerating write-offs, actually doing those things during the year. That is what's going to help protect you in case of a potential audit. So what I encourage everybody to do that's with us today is to contact your tax advisor. And there might be a charge to talk to them, but it's definitely going to be worth it, because when you talk to them during the year about what your plans are in real estate, those are where the strategies happen, right? It's not when they file your tax returns. It's before the year's over, before you buy something, before you sell something, before you put it into a legal entity. But one of the complaints we hear a lot is, my CPA doesn't do tax planning, or they don't maybe don't understand real estate. And because of that, we actually put together a tax savings program that's designed to help investors purely with tax planning. So this is good for people who, again, maybe they love their CPA, but the CPA maybe doesn't do real estate, or doesn't offer planning services, right? And so our planning program, basically, it is a hands-on program that we go through with investors to teach them the 6 most important areas that you need to know, and specifically what needs to be done to make sure you get the most tax savings. So we start out with maximizing deduction. What can I write off? How do I track those things? What are some systems I can do or put in place so that I don't have to worry about missed deductions?
Yeah, we do deep dives into all these category topics, right? So one week we talk about legal entity structure, like what is recommended for rental real estate investors, what's recommended for people that have active real estate businesses, wholesaling or a realtor, whatever the case may be. We do deep dive into that just so you can understand, from a tax perspective, what are the pros and cons, and what is going to work in your situation.
Yeah, and depreciation, we in our example, we talked about that couple that accelerated $245,000 of depreciation. So, but it was more than that, right? It was, did it make sense for them to accelerate depreciation? Maybe it makes sense for you, but it doesn't make sense for the person sitting next to you. So really getting into the heart of, does this strategy make sense for you this year, or is it better for you next year? We have a lot of people with short-term rentals, so short-term rental tax strategies, and real estate professional status. And just as importantly, how do you take profits out of your real estate, whether it's a sale or refinancing or changing it to the next generation, right? So a lot of those things that investors kind of need help with from a planning perspective. And here's some, great feedback. Actually, Lynn's feedback just came, I think, about a week ago. It was so amazing. She said she loved learning from the program, a lot of great information, and she was able to ask questions that she didn't even know she had because of that collaborative learning environment. She was able to hear from other investors and what their questions are and really getting to the heart of what her strategy is going to be. And then I also liked Marlene. She worked with us last year. She just had her local CPA file tax returns, and she said she was able to get a $107,000 refund. It was so amazing.
So we asked her to send us $100,000 of that.
Yeah. No, it's so amazing to hear, when people tell us those kinds of things. So if, again, if you have a CPA, great, make sure you reach out to them because the planning that you do with them is what's going to help you save on taxes. But if your CPA doesn't provide those services, then we do invite you to check out our website and see if that's something that would be beneficial for you.
Yeah, and I think one of the things that our clients like the most about the program is kind of what Lynn referenced here is that we do have weekly live group Q&A sessions where we kind of go in and everybody brings all their questions from that week's topic, and we kind of dive into their questions and bounce things back and forth. And so I think it's very powerful because, again, you may not even know you have this question, but somebody else does, and they're like, oh, hey, yeah, that fits in my situation, and I was thinking that same thing. So I think it's been fun for us too because we get to interact with everybody, kind of live on computer and everything, and see people's faces, and people are driving to and from work asking questions. It's pretty funny. So
yeah, I had someone call from like a hospital.
Yes.
Someone just had a baby.
Please tell me you're not operating right now. Somebody.
Yes. So that's it for our presentation portion. And Aristotle, we are ready for questions. Oh, sorry. So I forgot we do have a coupon code. Sorry about that, for the RealWealth Network. And so the investment in the tax savings program is $24.95, but using the code RealWealthTax, you can get a $200 discount as well. If you're interested in that, we would love to see you there.
And I'm assuming you can deduct this as an expense too, correct?
Yeah, I mean, I'm assuming the only reason someone is going to invest in this program is because they're investing in real estate, right? Yeah. And yeah, so if you're a real estate investor, then definitely a business expense, because there's no other reason for you to do it unless you just love to hear us talk and hang out with us for 6 weeks.
Great. Yeah, so you guys, you offer the, just to make sure it's clear to everyone listening. So you offer this great course, which is a great educational course for people to learn how to do this. And then, but you guys also are available for tax planning. Like you would actually, you could take somebody, like for example, a new client who wanted them to, if they wanted you to prepare their taxes, would you do that type of service, or no, you don't do that?
We do. So we do have tax return filing services as well. Okay. But our main focus is the planning, right? I mean, I tell everybody the same thing, like, sure, I can do the tax return, but if you didn't do planning and you just came to me to file last year's tax return, it's not going to be so much better than someone local to you, right? So doing the planning part and then doing the tax return is kind of the best ordering of things.
Gotcha. Okay, yeah, just so you guys do a little bit of everything, which is great. And RealWealth is all about educating, and you guys are all about educating and planning, which is great. And that's why we thought it'd be a great synergy to have with you guys, because you guys are along the same line. So yeah, go ahead and go to the next screen. I think the next screen is basically just there's like a yeah. So if you guys have your phones, anybody listening, you can take a picture of that, right? And it goes to your website.
Yes, yeah. So if you, we kind of try to share a lot of information in the last 30 minutes. If you're like, what is real estate professional, or what is the thing about short-term rental loophole and the depreciation stuff, was kind of just want more information around those topics, definitely check out our website. We have a tax savings toolkit that's a free download for all of you guys. So you can use that QR code or just go to KeystoneCPA.com. In there, we talk a lot more in that toolkit, a lot of additional things about those strategies. And we have a tax opportunity finder in there as well. Basically, it's a self-assessment tool. And at the end of it, the result kind of shows you where you are in terms of your risk of overpaying in taxes. So if you're on the low risk, that's great. That means you're doing great, with your current CPA. If you're on the low side, it kind of is you'll be able to see what are some opportunity areas that you might be able to work with, work in with your own, with your current person or with a different planning firm like ours.
Yeah, perfect. Yeah, and also just let all the listeners know, on our website, on the RealWealth website, if you go to realwealth.com and you log in on the resources page under it's under CPA bookkeeping, you'll see Keystone CPA's information there. So you'll have Amanda's or the main email. You can contact them at, the phone number, and the link to the course there if you wanted to read more about that as well. So that way people can not forget if they didn't hear the special or they got on later or they jump off, they can always go back. So yeah, let's go ahead and roll. We're going to roll into some questions here. If you want to go to the next slide, it's just a question slide there. So we got a lot of really good questions here. So we're going to try to get as many as possible. I know some of them are going to be very detailed and you probably don't have time to go through everything, but so let me go ahead and read a couple here. Let's see here. Okay. Profil, I hope I'm saying that name correctly, is asking, what are the rules or requirements for converting a vacant rental property since purchased in 2021 to a short-term or Airbnb in 2022 and then taking the active loss or depreciation runoffs?
Great questions. How do we convert a vacant rental from 2021 into a short-term rental from 2022? I mean, simple. You just start renting it out as a short-term rental, right? So if it's vacant, I'm assuming you have to furnish it and get it all ready. And once it's ready, you list it on Airbnb, and then operate it as a short-term rental property. The short-term rental definition, just so we're clear, for tax purposes, does not mean it's not limited to like a property being rented out on a specific platform like Vrbo or Airbnb. From a tax perspective, a short-term rental is defined as a property where the average guest stay is 7 days or less. So
yeah, and so that's really important, because if you have 8 days, 10 days, 15 days, even if you are putting it on Airbnb or Vrbo, that's going to be considered a long-term rental for tax purposes. So you definitely want to keep that. If you're looking for the short-term rental, keep the average customer use 7 days or less.
Yeah, and I'll get to, I think the reason we're having this question because he mentioned how to use the losses, and the difference is because for short-term rental investors, if you create losses on that property, you can potentially use that loss to offset your W-2 and other income, even if you're not a real estate professional. So this strategy works really well for a lot of our clients who are high income earners, just doing real estate on the side, right? Because the threshold to be able to use those losses are much lower than someone investing in long-term rentals.
Gotcha. Okay, great. Thanks. Okay, next question here. Sorry if I'm butchering the name, but it's Taye asks, so if we buy a property in our personal names and not an LLC or entity, can we still take all the same deductions? And you answered that question in the beginning, and the answer is yes, correct?
Yeah, of course. Yeah. So yeah, you do not need to have an LLC to take tax deductions. So for rental property, you can own in your personal name and take the same deductions you would if you did have an LLC. The LLC is there for asset protection reasons.
Yeah. Okay, perfect. Here's a very simple question. Lee asks, where are you located?
So we are located in Southern California, in Orange County specifically, but we have clients all over the US. And so we help investors nationwide with tax planning, specifically for real estate.
Perfect. Awesome. Okay. Let's see here. A bunch of cost seg questions. William asks, is there any way a simple way to do it on single family homes? I can answer that one real quickly. William, yes, there is a simple way. There are some companies out there that allow you to do cost seg studies via software, like from the company's website or their companies that allow you to do that. It's a lot less expensive to do it. Actually, Leah, one of our investment counselors, she did it on her own, one of her rental properties a few months ago, and it was pretty inexpensive. But they have like limits on the value of the property. So if it's like $1 million property, they won't let you do that free of software. They have to have someone actually do that. So it costs more to do that. But yes, you can do that. I don't know if you guys have anything to add to that.
Yeah, I think it's a common misconception that investors think cost segregation is something that's super expensive, that's only reserved for large commercial real estate. But that's not true at all. We have a lot of clients, like, we shared our example was 2 single family homes. They were able to get massive benefits from cost segregation. And yeah, whether it's an online software or even if you have a true cost segregation firm, we've seen it to be quite affordable. If it's like $1,000 to $2,000, but creating a $200,000 write-off, I mean, I would do that all day long, right?
Yeah, yeah. So it's definitely come down in price. It used to be, thousands and thousands of dollars. I mean, it still can be, but it's definitely sounds like software is making things a lot easier for people to do that on single family homes. So, okay, I know this is a very loaded question. I know you can just answer it real briefly, but Gloria asks, what documentation do you need to qualify for real estate status? I know it's a loaded question there, but.
So what we typically recommend is you have some sort of a log showing your time, your activities, and which properties your time relates to. The reason for the time log is because if audited for real estate professional hours, the IRS well, what you want them to do is testing, right? So you have a log of 600 different activities and dates and all that. And then they can take a sample selection from there and say, okay, well, here's the 10 things, 10 different dates and stuff I want you to prove. And so from there, you say, okay, well, I spent X numbers here, here's my receipt, or here's my email, or here's where I was at the conference. So there's not a specific method, there's not a specific, what am I looking for, like tool, right? It could be Excel, it could be an app, it could be your calendar, but you just want a consistent methodology for tracking. One of our clients actually created an app. She's actually a physician, but decided to create an app after going through our course, which is really interesting. Her app is called Reps Tracker, REPS Tracker. I think it's taken off really well. I went to a CPA conference and some other CPA was talking about how great it was. So yeah, whatever method works for you will be fine. Just use it consistently is the key.
Yeah, good question. Yeah, the biggest thing with a real estate professional, it's definitely. I might be wrong here, but it's definitely a red flag for auditing, right? Because the IRS is definitely looking for that, because you get a huge tax break if you're a real estate professional. But I know the biggest thing, since most of our investors are, they own property out of state, they're not doing the managing themselves. So that's the biggest thing that I've heard is that, you have to do what's called like active participation with your property management, right? And so if you have 10 different property managers managing all your properties and you don't do anything, that could be like, you might not qualify, or most likely will not qualify for that, right?
Yeah, well, it depends. I mean, I think the facts have to be different, right, for every single investor. But what we see a lot is, let's say we have an investor who has mostly out-of-state passive investments that someone else is managing. But what if they just have 1 or 2 local properties they're very involved in, right? And so what they can do is they can combine their hours. So if with their own local, 1 or 2 properties, they spend enough hours to meet real estate professional status, now they can combine all their real estate together and be able to use the tax losses from all properties. So just because you have out-of-state properties doesn't mean those properties are limited in terms of benefit. But you can always do more in real estate and change your facts so that you can get the maximum benefit. But I mean, if you just have 1 out-of-state rental property, then yes, it's probably very difficult with someone else managing it to create those hours.
Or even take the situation where you start taking stuff off the plate of your property manager, so you start doing more of what they were doing. Obviously, presumably paying them less because they're doing less now. But that's the way to kind of, even if they're still helping a little bit, there's ways to kind of make that work too.
Mm-hmm. And I think the other thing I just want to add too is again, going back to the facts, what are the facts of the situation? You don't have to self-manage forever, right? So this year I bought 6 properties. I'm spending a lot of time. I want to self-manage because I want this huge tax benefit to offset my W-2 income. In a couple years, in a year or year and a half, maybe I don't want to do it anymore, and that's perfectly fine. There's nothing that says you forever have to manage all these out-of-state properties.
Yeah. Okay, good. All right. Jason asks, if I purchase a 6-week course, does that include tax planning in the future?
Great question. So those are, so we do have both services, and we have people who go through the 6-week course. And then thereafter, they're like, okay, well, that's great, but I also want to work with you one-on-one. So yes, you can definitely transition to the additional service. The vast majority, I'll have to say, the vast majority of clients who go through the course feel like they have enough. So I think, I don't know, maybe less than 5%. Or maybe even less than 3% of people who go through the course actually end up deciding to work with us one-on-one. And we encourage that, because I feel like for most investors, unless you're someone like Brandon Turner, who just has a bunch of stuff, right? For most investors, especially people starting out, it's more cost effective for to go through the program, because not only do you it's lower price, but also you get to see what other people's questions are. And again, if after that you're like, hey, I want more, I want to do one-on-one, you can certainly do that.
Yeah, perfect. All right, good. All right, let's see here. Next question. Gloria asks, and this is a question I've actually had on strategy session calls, and this is a great question. She asks, what tax planning is necessary to rent a room in your personal residence? So this is like a question that came up on a call I had about a couple weeks ago, and they said, because it's very common that people are renting their rooms out in their houses. So I guess her question, you can answer the question what tax plan is necessary, but also my question would be like, can you get all those deductions? Because it's technically not the whole property you're renting, just a room, but maybe you can elaborate on that.
Well, yeah, so I think from a big picture, the way I'd look at it first is what type of rent are you going to rent to? Is it you're gonna rent to somebody is going to live there for 6 months, a year, kind of like a long-term tenant, or are you going to do short-term rentals where you're doing kind of the Airbnb model just with that one room in your house, and they're can use the kitchen or whatever, right? But so that's where I would start, and then from a tax planning perspective, you go from there. It's like, okay, well, what type of properties are going to be? In either scenario, you are going to be able to deduct a percentage of your home's expenses that you have against that rental income. So that's the good thing there, obviously.
Yeah, renting out a room, generally you're not creating a huge loss for tax purposes, right? Because even if you're taking depreciation, it's going to be a very small part of your house. But where we see this to be very valuable, like in terms of house hacking, is where it's like a duplex, for example, where you live in one unit and then the other unit is a rental. So it's much larger depreciation type of benefit. We also have investors through our program that has like a basement, for example. So they live on the top, and the whole basement with its own separate entrance is a rental. Those are examples where sort of like a little bit house hacking still, but creating some pretty significant benefits. So the structure of the property itself also comes into play. So when you say room, is it specifically just that room, or is it like the basement of the whole house, right? That differs in terms of the tax strategies.
Yeah, interesting. Okay, good, great. That's good to know. Okay, Jane asks, or she says here, they're a married couple that they both have high-paying W-2 jobs, multiple rentals out of state, one rental in town that they self-manage. They cannot qualify for real estate professional. Can we deduct home office, car, and meals if we stay in town, did not travel out of state? I don't know if that makes sense to you guys or not.
Yeah, it's a great question. One we get a lot too is people thinking that they have to be a real estate professional in order to claim certain expenses.
Yeah, which is not true at all. So, as real estate investors, again, you've got your income you got from your properties plus your expenses. So if they are ordinary necessary to business, which home office would be, using your car to travel places for their local real estate, those are ordinary necessary expenses. You should add that to your bucket of expenses to deduct against your income. The real estate professional just comes into play as if you happen to create a loss on that property or properties, then can you use that loss to offset your W-2 income or other income? That's where real estate professional comes into play. But that has nothing to do with your ability to deduct home office, car, dues, all that kind of good stuff.
Yeah, I think the only difference between real estate professional and not real estate professional is the timing of when you benefit from those deductions, right? So like Matt said, we can claim all the same things. But if I'm a real estate professional, maybe I can offset my taxes immediately this year. If I'm not a real estate professional, I still claim those expenses, but it's just helping me to offset taxes from future income. So future rental income or future income when I sell a property, right? So there's always a benefit. It's just a matter of timing of that benefit.
Okay, great. Kathy asks, I've owned a property for 10 plus years. How can I utilize accelerated depreciation, or can she?
Yeah, that's a great question, Kathy. So yes, in practice, you can do cost segregation at any point of ownership in a property. A lot of people think they have to do it in the first year of buying it, but that's not correct. You can do it anytime. 10 years is a little bit iffy, just because it's a bigger number of years. So what I would encourage you to do is to do a cost benefit analysis. And all you do is you can, go on one of those online software that Aristotle was talking about, or you can, contact one of the cost aggregation firms, because what they can do is they can take a look at your property. They can look at how much depreciation you've already taken and give you an idea what is that additional benefit, if there is any, on that specific property. So technically the answer is yes, you can do a cost seg even after owning it for 15 or 20 years, but the benefits will be smaller versus if you would have done it in year 2, 3, or 4 of owning that same property.
Yeah, great, that makes sense. Okay, Chad is asking, how many audits have you been through, and what is the results of the audits? I don't know if you want to give that information or not.
Yeah, that's a great question. So we've been very fortunate. When we do, again, our whole focus is on tax planning. If you're doing the right things and you have the right documents, that is to protect you in the event of an audit, right? So I never have people say, oh, I don't know if I'm a real estate professional, I'm just going to claim it anyway. That's not the right way to do it. And also the way you file your tax return, doing things right, reporting things the right way also helps to lower audit risk. So we've been very fortunate, I think, in terms of audits. I think we have about 500 clients. We try to keep our tax return client numbers fairly small. We probably get one audit like every other year, historically speaking. So, maybe half of an audit per year. The results have been pretty good. I can't think of one where it has been terrible. In fact, we get a lot of no change audits. A lot of our clients do a lot of real estate where, if they have the right documents. I think, unfortunately, what I see a lot is CPAs will kind of use a scare tactic with investors and say, gosh, if you claim this, you're going to be audited. If you do a home office, you're going to be audited. Our experience has been auditors are people too. They're very nice. They're reasonable people, right? So if you're going to show them and demonstrate what you're doing, what expenses you had, they're very reasonable people. They're not like the scary monster out to get you. Although I don't know, that might change. I don't know. I'm not sure.
I don't know. Well, maybe the audit people are nice, but whenever I call the IRS, they're usually not very nice on the phone there. So I've had to call them a couple times before. Okay, let's see. We've got time for a few more questions here. We've got a lot of questions on short-term rentals because that's obviously in the last few years, short-term rentals have popped up. And RealWealth, we have a couple of property teams that offer short-term rentals, and so. I think it's timely because we've been offering short-term rentals for a couple of years now, I think, and it's a great way to go for some people. But here's a question Gunther's asking: do short-term rentals qualify towards hours as a real estate professional? But I would probably have to say yes if you're working it, right? If you're doing all the active work, I would say possibly, right? Because you're managing everything.
Well, so yeah, so there's a couple ways to look at it here. So for a real estate professional, you do need to get to 750 hours in real estate and more time in real estate than your other jobs. Now, if you happen to, again, real estate professional status is going to be applicable or beneficial for people with long-term rental properties. But maybe somebody has both. Maybe they got short-term and long-term. Any hours you do spend on your short-term rentals can help you get to that 750-hour mark for real estate professional and more time in real estate than your other jobs. But what it doesn't do is one of the things for real estate professional is you also have to meet one of the material participation tests, which, we could spend a whole hour talking about that, right? But you have to meet one of the material participation tests for your long-term rentals. So your time on your short-term rentals doesn't help you do that. It can help towards the 750 hours, but it doesn't help you say that I've been, actively involved managing my long-term rentals. That doesn't help you do that.
Yeah, I think, this is more for like CPAs. There have been court cases where the IRS or the tax courts have said short-term rental hours are not part of real estate professional. And I think this is what this specific question is stemming from. Maybe this person's CPA has said, no, I'm not going to count that because of this, or, because of this court case. But our position, we agree with you. It's like short-term rentals are still real estate, right? Just like if you're a realtor or a broker, that's a real estate, and those are real estate professional hours, and so short-term rentals sort of treated the same. But for someone who's specifically investing in short-term rentals, the key thing to understand is that you don't have to be a real estate professional, right? So if all you're doing is short-term rentals, real estate professional is not applicable, right? It's not relevant in your scenario because you just have to worry about your hours on the short-term rentals. And that again is another big common mistake we see from investors working with CPAs who maybe don't really understand that short-term rental loophole.
Okay, perfect. Let's see here. Mark asks, if you take too many deductions, will that unqualify you for financing? That's a great question, right? So you guys can talk about that, because that's a big thing to talk about.
Yeah, we get this question a lot. It is definitely on the minds of a lot of investors, obviously, is because they want to be able to qualify for loans, use leverage like we're talking about. So you just have to be, we like to say you have to be strategic about it. So the way you do that, the way we recommend you do that is, first work with a mortgage broker or a lender that is familiar with real estate investors. So you don't want to work with somebody who deals with precedent loans all the time, because they're not going to understand when they look at a tax return and say you took $50,000 in depreciation, that's a big loss. They're not going to understand that doesn't mean they think you spent $50,000, right? You got a huge amount of expense. So you need to work with a mortgage broker who understands real estate investors. And the other recommendation too is, if you are, around tax filing time, or if you are kind of in the process of getting a refi or getting a new loan, get a draft of your return in place. So get a draft, take the draft, send it to your mortgage broker, have them look at it, and give you some feedback in terms of, do I qualify? If not, why? What do I need to tweak? And then talk to work with your tax advisor or tax preparer about that, because in our position is you definitely want to take the deductions you're entitled to, but again, you need to be strategic about it.
Yeah, and there's a lot of things that we take for deductions that should not hurt you in the debt to income ratio. So depreciation, for example, depreciation, cost segregation. If you're working with the right lender, they can explain all that to their underwriters. Same thing for like car and home office, right? Those are things that they're already factoring in your home payment and car payment, so they shouldn't count that against you on the tax return a second time. Or maybe like even retirement contributions. Those are some discretionary things you're doing purely for tax savings. So yeah, I think like Matt said, just working with a strategic mortgage lender and your CPA as a team.
Perfect. Okay. Tanya asks, if you take bonus depreciation now, how does that impact taxes when you sell the property? So like that called recapture, right?
Yeah. So anytime you do sell property, you are going to have potential depreciation recapture. If you happen to take more depreciation up front, you're going to have a bigger gain on the back end because your tax basis is lower. But having said that, a lot of the times, accelerated depreciation, cost segregation makes sense from a time value of money savings. At the end of the day, don't recommend it if you're going to, do a cost seg and sell it probably 6 months later. That doesn't usually make sense. But again, when you fast forward down the road when you're going to sell a property, there's a lot of things you can do to minimize depreciation recapture issues, just by changing how you allocate sales price, which assets, and there's a whole lot. You can do tax deferred exchange where you don't have to worry about the depreciation recapture at all right now. So there's different things you can do.
Mm-hmm.
Okay, perfect. All right, let's see what time we got. We can do maybe a couple more questions. Let's see what we can find here. Something we haven't talked about yet. I'm going to try to stump you guys. Let's see here. Cost seg stuff. We kind of talked a lot about that already. Oh, well, here's Taye asks, if you don't have an LLC, are you now considered a sole proprietor for tax purposes? And if so, is there a downside to being a sole proprietor?
Yeah, assuming you're talking about rental real estate, yes. If you don't have an LLC, then you're just investing in your personal name. There's really no downside typically from the tax perspective. Of course, the downside would be more from a liability perspective, because now you're operating rental properties in your personal name and kind of the risks associated with that. So, but that's just a conversation to have with your attorney, right, to see whether an entity will make sense. But tax-wise, for landlords, typically it's writing off the same expenses, same deductions, same depreciation either way.
Gotcha. Okay, gotcha. All right. What is the general deadline for cost seg? We purchased several new constructions in 2020, this is Jane, sorry, Jane. What's the general deadline for cost seg? We purchased several new construction homes in 2020, 2021, but can we do cost seg in 2024?
Yeah, there is no deadline. So as we talked about earlier, you don't have to do a cost seg in the year that you bought the property. You don't have to have it apply to the year, the tax year that you bought the property. You could do it 3, 4, or 5 years down the road if you wanted to. The one question that comes up a lot is, if you are going to do a cost seg for the tax year, it just needs to be done by the time you file the tax return for that year. So it doesn't have to be done by December 31st. It could be as late as April 15th, it could be as late as October 15th if you extend your returns. So yeah, just something to kind of keep in mind there.
Okay. David asked, what is the definition of a short-term rental? I don't know. You guys talked about like the time frame, right? Did you take 7 days minimum or something, or what did you say?
Yeah, so that's a great question. So the definition of a short-term rental for tax purposes is a property where the average guest stay during the year is 7 days or less. Okay, so during this year, if my average guest stay is 7 days or less, it's a short-term rental. If it's longer than 7 days, that's considered a long-term rental. So now we're seeing a lot more midterm rentals popping up. And so midterm rentals pretty much are all long-term rentals, right? So 7 days or less is short-term rental. And that's the average guest stay during the year.
Awesome, gotcha. Okay, let's see. I think we can do one more question here. Let's see here. Yeah, a lot of short-term rental questions. That's great. Yeah. Okay, Sharon asks, does a cash out refi increase basis when you sell the property?
Good question. So cash out refi does not increase basis, and the reason why is because keep in mind that when you do a cash out refi, you're increasing a loan balance, you're adding a new loan or property or what have you, right? You're not paying taxes when you receive that money. It's just a loan that you have to pay back at some point in time. So it does not change your tax basis in your property at all.
Right, and it's tax-free. The cash that you pull out is tax-free, which is great. So, well, good. Well, I know we have a lot of other questions, but I know we're running out of time here. So let me ask you guys a quick question. On your tax savings course, do you guys talk about some of the things we talked about today, like real estate professional status? Do you talk about that at all? Because people have a lot of questions about that stuff.
Yeah, we do, and the difference. So, in the program, so obviously today in a forum like this, we don't know the investors, right? We don't know what their situation is, so it's harder to have a very specific question, which is talking about what the law is. But in the program, we get insight into what the investor's profile is, so we can kind of help determine, is real estate professional something that makes sense for you this year, or if not, is it next year, or if not, is short-term rental the better strategy? So definitely, just like Matt said, taking a deeper dive into all those related topics.
Okay, perfect. Matt, can you advance to the next slide? I think the last slide is just a thank you slide. And so, but yeah, I definitely want to appreciate you guys. There's we have a lot of questions. This is always a great topic to talk about, but I really appreciate you guys coming on and talking to our members. And you guys have a lot of great services you offer. And so again, for those who are still listening here, yeah, you can go to, if you didn't catch the information, you can go to realwealth.com, log in, and under the CPA bookkeeping tab there, you'll see Keystone CPA's information. So you can reach out to them directly there if you have other questions, or if you want to set up a consultation or check out the tax savings course there. But I really appreciate you guys coming on. So you guys have a great rest of the year, and thanks again.
Yeah, thank you.
Yeah, thanks for having us. Appreciate it.
All right, bye guys, thanks.